Hi, everybody. Thank you for joining in. Today, we'll be just getting Shane, Max, and Stuart on real quick, so they should be here any moment now. Thanks so much. I'll make sure they've just joined. In the meantime, I'm actually going to be sending across a poll to get some information on everyone that's here. So first one, you should be able to see how often you've interacted with DeFi, just so we know how much to talk about of DeFi. I'm going to do a similar one for NFTs as well, just so we get some bit of context as to who the audience is today. And also, don't forget, we will be having about 20-minute Q&A at the end. So feel free to send across any questions you may have. There's actually a questions function there. So if you can send through any there, that'd be awesome. Hey, Shane, thanks for joining us.
Hey, Eamon. Thanks for having me.
Hello.
Hi, Stuart. Stuart's our guest today. Very excited to have him on board from TaxScouts. Thanks so much for your time.
No problem.
Perfect. Well, I've just sent across a poll to the audience so we can see if they've done any DeFi trades or any NFT trades, just so you know a bit of context. But I think you guys are more than happy to take it from here, Shane.
Yeah, look, definitely. So we've just got Max joining as well, but I'll start the presentation for everyone. Can you guys see my screen okay?
Yeah, that's perfect.
Yeah, look, so today we've got Stuart joining us from TaxScouts to talk about some of the common tax issues that come up around cryptocurrency taxes, especially in the UK with the Hmrc rules. They're quite unique compared to the rules globally. So the important thing to note with crypto tax is that it's not anonymous. When you're actually trading on the blockchain, for example, there's a clear ledger. It's publicly visible. And so when you're moving crypto from exchanges, that's recorded on the blockchain. If you're trading from MetaMask directly in your wallet, on Uniswap, if you're doing Aave lending pools, if you're doing any kind of DeFi activity whatsoever on chain, it's all pseudo-anonymous. There's a public wallet address, obviously, but that's all those transactions are recorded onto the blockchain, and they're recorded for as long as that blockchain survives. So, you know, all transactions that have ever occurred on Bitcoin, for example, you can look up. So it's just important to keep in mind that these transactions are pseudo-anonymous and not anonymous. And as soon as you do some sort of KYC, whether you're moving money onto the system in effect or off the system in terms of cashing out, there's going to be a path for the Hmrc to have a look and inspect and see what you've been up to, and that data is not going to go away. So at the moment, the Hmrc is sending out nudge letters to cryptocurrency investors, talking, you know, kind of reminding people of their cryptocurrency tax obligations. And, you know, when they start to send out nudges, that's usually the precursor for more serious enforcement action. So what we're seeing globally at this stage is a lot more activity from tax authorities as they've started to realize Bitcoin isn't going to zero. They've started to build out the systems to have a look at closing the tax gap when it comes to cryptocurrency. And at this point in time, they're still in the education stage of making people aware, but you know, the tone's going to change. So it's probably important to get on top of it if you haven't been on top of it already. Understanding on how difficult it could be. We work with a lot of users who might not have been doing their tax records since 2017, 2016, since the last ICO boom. And yeah, it's super painful, and you've got to go back and try to get all those records up to date, which is where Crypto Tax Calculator kind of comes in and helps you out. So what we're going to do is talk, I'll hand this over to Stuart. He's going to talk a little bit more about the capital gains and income tax in the UK. Stuart, do you want to take the lead?
Yeah, thanks, Shane. Can you if you just hop back to the Hmrc slide for a second? I just wanted to speak about that briefly. The receipt of a nudge letter from Hmrc, you know, doesn't mean that you've done anything wrong yet. it's more of a, you know, Hmrc have lots of data, and you know, we know that you've got these things. Do you want to bring your affairs up to date if they are not? So if you have received a nudge letter as a taxpayer, as a UK taxpayer, my first advice would be obviously not to ignore it. You know, I would raise the question with a UK tax professional. As Shane said, this is becoming more and more relevant on an international basis. As an example, if anyone knows how onerous the US tax system is, on the 2020 US tax return, after you've filled in your name and address, question 1 is, have you at any point in the 2020 year bought or owned a virtual currency? So, you know, it's front and center in the minds of tax authorities. So if you do get a nudge letter, it is definitely worth looking at your affairs. But let's not put a dampener on the presentation from the start. So if we can move to the second slide, please, Shane.
Also, Shane, we're just getting the chat. I believe that you might have your notifications turned on real quick for this live storm. So if you wouldn't mind just checking on the bottom right of the dashboard, you should be able to mute your notification sounds. Thanks so much.
Yeah, mine are muted.
Perfect. Yeah, just that icon on the bottom right, the bell.
Yeah.
There we go. Perfect. Too easy. Thanks, guys.
Right, that should be better because I think that's now coming through the headset rather than the computer microphone. So apologies for that. I can see a question in the chat there from a listener called Nick Cattell. So we're going to talk about that right now. So the main point that we see from a UK perspective with capital gain, with cryptocurrencies, is that it is buying and selling of an asset. Obviously, a couple of years ago, before everyone knew what crypto was, can you guys hear me or not?
Yeah, definitely.
So before everyone kind of knew what crypto was, a lot of people thought, you know, it's just gambling because it's quite risky, or secondly, they said, oh, it's an actual currency, and you know, you'd only pay capital gains tax on a currency if you are buying and trading currencies, you know, on a sort of daily basis as a currency trader, not from a CGT perspective. But obviously where Hmrc have landed is, you know, these are assets. They can be converted to fiat currency, GBP. And, you know, so predominantly we're looking at capital gains tax being payable on the purchase and sale of these assets. The bottom bullet point, there is the potential for income tax on some different parts of the cryptocurrency world, but I will leave Shane to explain those because they're the sort of techier part of cryptocurrencies. To the question from the chat, Nick, I hope you can hear, but reporting for UK capital gains tax purposes, there are two tests. One is where an individual has capital gains in the year above the 12,300 annual exempt amount. So that's every person that's UK resident can have or can make annual gains of up to £12,300 before they start having to pay tax. The other threshold is individuals who sell total assets in the year that have a value of over £49,200 sterling, so that's 4 times the tax-free amount, they have to report those transactions irrespective of whether there is a gain or a loss. So example, if you sold £60,000 worth of crypto, but you only made £5,000, you'd still have to report that. I guess the third point is if you end up with a capital loss, you would also like to report that on a UK tax return so that you can carry it forward against future capital gains. Middle bullet point, in terms of events, when it comes to the purchase and sale of UK assets, there are a few different kind of triggers. So obviously selling an asset or giving an asset away would be the same, because you're deemed to give that asset away at the market value at the point that you give it away. Similarly, complexity comes in with crypto where there is swapping from one crypto to another. So if you sell Bitcoin for Ether, that would be a chargeable event for UK purposes, and you would need to look back, or you would need to convert back to the fiat currency to work out what your gain is. Obviously, the conversion back to fiat currency, or cashing out, is a sale, so is a tax point. And if you use the cryptocurrencies to obtain goods or services, that's another tax point, because of, again, you're effectively disposing of the crypto. Income tax may also apply. So as I said, later in the presentation, we can think about staking or mining. A lot of questions that we're getting as tax advisors in the UK is people who, they're doing a lot of crypto trading, and they're wondering whether they are running that as a kind of trading business, almost as a self-employment, because that would switch out your tax position from CGT to income tax. Now, it's outside the scope of this presentation, but when it comes to determining whether you are a self-employed trader, there are 9 different badges of trade, which I won't go into now, but you're really looking at that being a full-time job rather than just buying and selling crypto on the side as a sort of side hustle, and that puts you into capital gains. So if anyone does think they are trading as a sort of crypto day trader, self-employment, I would urge them to look up the 9 badges of trade on the Hmrc website, and then probably reach out for some professional advice. Thanks, Shane. So as Shane has mentioned, the UK has some strange rules with regards to capital gains tax. And what we've seen is that these rules, they haven't sort of fitted in with the early stage reporting that we've seen. So the slide there, as it says, average cost basis is what we would normally look at for UK assets. So you buy an asset for a price, you then buy a second asset for a price. The 2 assets are deemed to have an average price of those 2 purchases. Now, the complexity that we see with crypto is volume of transactions. So your average cost calculation can be very complex if you've got assets coming in and assets coming out. The other point, and I will refer to Shane, he can correct me if I'm wrong, but if you're holding the same crypto across multiple wallets, then the average cost price for UK tax purposes is calculated across all of those shareholdings, or all of those wallets. Shane, I assume that can be done.
Yeah, absolutely. So it's using something like Crypto Tax Calculator, it unifies your transaction history, and then you can work out the average cost basis on a universal kind of perspective.
Yeah, so it doesn't matter where you're holding the crypto, whether it's in the UK or whether it's in another country. I appreciate geography doesn't really exist when it comes to crypto, but looking at this from a traditional kind of shares perspective, say you're holding a share in a UK brokerage and holding a share in a US brokerage, when you calculate the average cost basis, it needs to be done across your entire global holding. So again, another kind of complexity there. And what we've seen, as I said, in terms of early stage reporting, is a lot of kind of Excel CSV files that seem to report on a last in, first out basis. What I mean by that is I purchase a share today, I purchase another share tomorrow, I then sell a share, and it goes in order, rather than the UK rules that are average cost basis. And so working through those CSV files has been a little bit of a pain for tax professionals, and so Crypto Tax Calculator is a perfect solution for that. Shane, do you want to add anything on that?
I think you've said a good job there. Yeah, the calculations there, especially if you've got quite high volumes, they become really difficult. We can go into some of the calculation examples later on, point out just exactly how these look.
I see Nick Cattell has put another question in. Airdrops will be mentioned later alongside staking and mining. So just sticking with the CGT for now, another complexity under UK rules is that sometimes the average cost basis will not apply. The first instance where it will not apply is when you are buying and selling the same asset on the same day. So as the slide says there, trades made on the same day are grouped together and matched, and then the leftover is added to the pool. So probably better off looking at it through an example. Obviously a very simple example for this purpose. Shane, if you want to. So in this example, we can see we've got 2 buys on the 4th of January and a sell on the 4th of January. Those will match off against each other. So those 2 buys, you've obviously bought 2 units for a total of 4,000. You've then sold a unit for 5,000. So you've got a gain of 3. And then the remainder is added to the pool. Okay, clear as mud. Andrew Sadler says you take the assets of the same type, only the net change for the day will be added to the average cost pool. I mean, that's broadly correct, right? Shane, anything to add?
I'd say the HMRC rules, we work across many different countries, and these HMRC rules are some of the most difficult to be compliant with. So definitely.
Okay.
Yeah.
Well, the next one is even funkier. So from UK perspective, we have another rule which is called bed and breakfasting. And this is effectively where if you sell an asset today and you buy the same asset back again within a 30-day period, the transaction sort of doesn't really exist for UK tax purposes. You're deemed to sell the asset today, or sorry, you're deemed to sell the asset that you bought next week today. So again, if we move on to an example, I appreciate this is all a little bit conceptual if you haven't worked in tax for 18 years. So in that example, we can see 1st of January, a purchase for £10,000 or 10,000, whatever currency we're talking about. On the 3rd of April, we've got a sell for 22,300. So traditional thinking, you would be like, happy days, I've got a gain of 12,300. But then within the 30-day period after the 3rd of April, you're back in the market and you've rebought the asset for 24,000. And so instead of a gain of 12,300, what you've actually got is a loss of 1,700, because on the 3rd of April, you are deemed to sell the asset that you bought on the 8th of April. There's probably a couple of useful questions to pick up there in the chat, Shane, if we've got a second. So Richard Devereaux, I think yours is an easy one. So what if you sell one coin and buy a different coin within 30 days? So in that scenario, I would say that you are buying and selling different assets because they're different coins. Rob Giles says
a quick poll just so people can actually share whether they're clear about the BNB rule after this explanation, because I know it is quite a complicated ruling. So if everyone could vote real quick just so we get a bit of an understanding, that'd be awesome. Thanks, Drew. Back to you.
Okay. There's a comment there, maybe this is for Shane, but there's a comment there for Rob Giles. He says, as a crypto tax accountant, what do you need from me to do my taxes? Is it as simple as a wallet address and list of exchanges, API access keys, or access to crypto tax calculator? In this case, would all my transactions need resolving, or a lot more in information in advance? I mean, from a UK tax perspective, the reports that crypto tax calculator produce are perfect for our requirements in terms of entering the data onto a UK tax return and attaching the PDF backups to that return. So perhaps it's more a question for Shane in terms of how the data is put into crypto tax calculator.
Yeah, absolutely. There'll be a demo towards the end of this presentation where we can go through and do some examples there. And essentially, you're quite right. You'd enter in your public wallet address. So obviously no private keys, just a public wallet address. And either the CSV exports from the exchange itself. We support lots of different CSV formats from pretty much every exchange you can think of, as well as you can enter via API keys as well, depending on how sophisticated you are, and pull in the data automatically. With the public wallet addresses, if you've been trading on something like Uniswap, we pick up the liquidity pools, we pick up the trades on DEXs, even like the NFT distribution events, etc. So there's just a matter of getting all the data into the system. The system is smart enough to try to work out what's been happening, or it will throw errors where there's uncertainty and ask for your confirmation, essentially.
Okay, so I think there's a lot of questions coming in, just I guess in terms of bringing your, if you were to join Crypto Tax Calculator, bringing your data up to spec if you haven't done it previously. So perhaps we'll park those just to finish off the tax piece. Damien says, I assume for a day trader who is swapping and selling many assets each day, both bed and breakfast and day rules apply each time. Yes, I would agree. That's going to be very messy. Mike Mick has asked, do wrapped assets count? So selling Ether and buying WETH on Matic. I'm really going to have to defer that to someone that knows what WETH is, because I have not heard of that, I'm afraid.
So yeah, we're talking about wrapped ETH. So now you're entering the vortex of unknown when it comes to cryptocurrency tax. What we can say, what I can say is conversations I've been having with other tax authorities, because essentially the tax authorities are still building out a view, I would say, of what this might be. One strong argument that I've heard, and this isn't tax advice, you should always seek out your own tax professional's perspective here, is that because the nature of the digital asset has changed, so the digital properties have changed from ETH, which is like the native token of Ethereum, to wrapped ETH, because there's a change in that digital kind of rights, that is actually a capital event. So that's the strongest argument I've heard so far. There's arguments to say that it's actually just kind of like a transfer, and that the rights are still the same. So it really depends on, we're still to be decided what this looks like. In our calculator, conservatively, that would get pulled in as two separate classed assets, and you'd have to edit it if you wanted to declare it as the same.
Okay, so TBC on that one, I think. Okay, I think we've now got a lot of specific kind of CTC questions coming in. So from a tax perspective, obviously, I appreciate it's been broad brush, but the CGT, as Shane has said, this UK CGT rules are very strange, and it is worth, I think, getting some assistance with those in terms of the matching rules and the reporting. So I'm going to hand back to Shane, but still chip in terms of other parts of the cryptocurrency world, and where we can sometimes see an income tax exposure in the UK.
Yeah, so the Hmrc recently clarified that staking rewards are taxed as income. This wasn't a real surprise for us. Most other countries have already, there's a few other tax authorities have already come out and said the same. To them, it looks very similar to interest, like you've got some sort of deposit and you're accruing interest on that kind of deposit of the asset. Essentially what happens is when you actually receive the asset, say if you're staking ETH and you start receiving ETH rewards at every 6 minutes on the epoch, you'd have to work out what the market value was of that ETH as it enters into your wallet, or as you have the right of ownership to that reward. And then you'd work out the market price, and that would form your cost basis for when you dispose of it. So something that was coming up on Reddit when this was kind of first came out was like, oh, so I've got to pay income tax, like £1,000. Like say you receive £1,000 worth of assets, do I have to pay income tax on that? And also when I sell it for £1,000, you have to also pay CGT tax on the £1,000. And the actual difference is what you start paying the CGT kind of tax. So you're not kind of really double tax. It's more like, it's kind of like, rather than getting paid in pounds, you're getting paid in crypto, really. That's the way that they're kind of thinking of it. And then what you're kind of doing is, rather than getting paid in pounds, you're getting paid in crypto, and then you're choosing to hold that crypto and the fluctuation is where the CGT event lies. And the important thing to note here is what can happen with some of these staking, like farming rewards, for example. You might earn $100,000 worth of eggs, or £100,000 worth of egg tokens in 1 week, and the whole market crashes out because, you know, it's a Ponzi scheme or whatever, and then it drops out, and you end up having this kind of loss, which is a capital loss on top of your income. So that can be pretty confusing, and something to keep in mind, like the exposure you have when receiving staking rewards. And by holding it, you're choosing to continue having that tax exposure. The other thing, there's quite a lot of still uncertainty about liquidity pools, like when you deposit assets into a liquidity pool and receive a liquidity pool token back. Is that a taxable event from a CGT point of view? It's not super clear. I've heard more conservative arguments that it might be, and more, I guess, aggressive arguments that it might not be. But there's still certainly suggest talking to your tax professional about that. Another thing that comes up is, at what point do you have to record the receipt of the staking reward? So this is really getting into fringe areas, but well, it's still grey, I suppose. But there's one perspective there which is actually quite hard. It's going to be hard to comply with, which is that actually when you deposit into a liquidity pool, the interest that's received into that liquidity pool, you have to record it at that point rather than when it comes back to your wallet. That could be a really big added complexity, and we're still not sure if this is the case. And I know of a few cases going on at the moment that's trying to seek clarification around this outside of the UK. What happens is that most of these tax authorities tend to communicate with each other, so there'll probably be some sort of convergence, but there's just this degree of uncertainty with these types of advanced financial products in cryptocurrency. And it's something to keep in mind, like from a tax exposure point of view. Yeah. Did you want to add anything to that, Stuart?
No, I mean, we've talked about this before. It's the simplistic view from the UK perspective is, you know, it's bank interest, right?
Yeah.
You're lending an asset to someone else in the same way that you might lend some cash by depositing it in the bank, and you receive an income for doing that. And that's a very simplistic view, but that's how Hmrc are kind of viewing it. There was a question further up in the chat that from Kevin Harvey, who says, staking rewards are treated as income and thus income tax. Is there national insurance? The answer is no, because it's, as I said, it's treated as, the legislation refers to miscellaneous income, but it's bank interest.
Yeah, and there's another point here. You know, one thing that's been coming up is it actually a deposit? There's another argument there, which was that it's actually kind of like a disposal with the right to buy back at a later date with interest accrued. So that comes back to liquidity pools. So that kind of area of, like, when you actually deposit into a staking protocol, is that a disposal or a deposit, is also something to keep in mind. And it might be different whether it's on an exchange or whether it's on like a smart contract with an actual liquidity pool token in return, etc. So definitely seek clarification from your tax professional.
Stuart's just disconnected, so might want to give him a couple of seconds to rejoin.
We scared him off with the staking.
And when you mentioned WE, he ran off. Also, whenever you guys are ready, of course, after the demo, we do have some questions lined up. So
Yeah.
If you want to take those, let me know.
Yeah, cool. So I might just continue. Hopefully Stuart can join back on shortly. Yeah, so airdrops, the Hmrc also considers airdrops as income if you've done something to earn the reward. It's not super clear where that line is drawn. It's still kind of open to interpretation. But if it was income, then when you go and sell it, the income received acts as the cost basis. Yeah, to reiterate, it's not super clear where that border lies as to when it's income or when it's free, I suppose. And if it was free, then it would be a zero cost acquisition from a tax perspective, according to the Hmrc rules. Is Stuart back?
Hello, I'm back.
Just in time for mining. Do you want to have a talk about that?
Yeah, I mean, I'm sure it's a lot more technical than I will ever understand. So I will revert to you on that, Shane. But with HMRC's interpretation of the kind of crypto asset world, they have sort of come to the opinion that mining is a self-employed sort of trade, because there's a lot more kind of work that goes into it, rather than just buying and selling an asset.
So hard forks is an interesting one. Yeah, so this is something which was more common a few years ago with Bitcoin forking into half a dozen different chains like Bitcoin Cash, etc. Essentially what the Hmrc kind of came out and said was that the new holdings would go into its own cost basis pool. That's also something to consider, is if you've received kind of new crypto from the hard fork and what the tax implications might be there. Fees, did you want to talk through the fees, Stuart, or do you want me to pick this one up?
No, you can you crack on.
Yeah, so
I think it comes back to the point that if you're using the crypto to pay a fee, then that is a disposal.
Yeah, correct.
And so that is a tax event. And as we discussed the other week, with CGT, with UK capital gains tax, fees for buying and selling an asset are deductible if they are wholly and exclusively incurred for the purposes of buying and selling that asset. Now, my understanding, and Shane, correct me if I'm wrong, is that there are a range of different fees payable. Some would be a commission for buying and selling those assets, but some would be almost an access fee, to get into the market, or a membership fee or something like that, which again, doesn't attach to a specific transaction and is therefore not deductible.
Yeah, so for example, if you're on Uniswap and you go to enable the interaction of that market, quite possibly that gas fee isn't necessarily related to a particular commission per se, so that might not be claimable, essentially. The other one was kind of moving funds between wallets, etc. It's not clear. Doesn't seem like it's going to be claimable either. But you should always talk to your tax professional. But something to keep in mind is that not every fee seems to be claimable. The other point is that if you're splitting between, say if you're selling crypto for another crypto, so say we sell Bitcoin for ETH and the fee is in ETH, you can't always just bring that fee forward into this financial year. Essentially, that's kind of what the Hmrc was saying. You need to have some sort of logic there as to how you split the fees. Like, it needs to be fair, so that it's sometimes on the purchased asset, sometimes on the disposed asset, if that makes sense. Rather than saying always, oh, we're always going to claim this fee in this tax year. So here we've got some example transactions and just how complex this can be. So you can see we've got multiple purchases across multiple dates, and we've had to keep track of the average cost basis. And then we've got one disposal. The disposal, we've lost quite a bit of money, almost £1,000. But to just add to the complexity, we've got a fee to enable that disposal. This was on chain, so we've had to pay a gas fee. And the fee here actually had a gain. So that gain offsets the loss. And that's how you get this 917 instead of 949. And then the total fee is added to the cost basis here. So this is just one transaction. It's very common in crypto to rack up hundreds or thousands of transactions. We're expected to record all of this information. It's very fun. Our solution, we work as an individual. You can import all your data into the app, and essentially we're like a bookkeeping tool. So you don't have to keep records of something like this by hand in an Excel sheet. You could just import everything. We'll help you with understanding your entire portfolio. You can review all your transactions. You can categorize them accordingly. You can bulk update, bulk edit, however you see fit. And then you can download reports at the end of the tax year and send those over to your accountants so that they can help you file your tax returns. We handle quite complex scenarios such as liquidity pool tokens, gas fees, NFTs. We've been really focused on handling on-chain transactions. So since 2018, we've been prioritizing how do you handle kind of transactions on the Ethereum network and derivative protocols. And even though it's suddenly in the last year and a half that's become really popular, we've been working on that solution since 2018. It's extremely complex, but it is possible to get all this data from the blockchain and be able to keep track of everything. And I'll do a demo towards the end as to how this actually works. Stuart, do you want to talk about the key dates? Stuart's still there?
He was. Maybe he doesn't. Maybe he got scared.
I'm here.
Okay, awesome.
So the UK has its strange tax year that runs from the 6th of April to the following 5th of April. There are questions as to whether that should be changed and whether we should align with the rest of the real world, but that's TBC. For anyone that is already within self-assessment, hopefully familiar with the UK's filing deadline of 31st of January following the end of the year. So we've got about 9 months to get everything together, and similarly payment at the same time. Another point to mention is if individuals are not within self-assessment, so not already filing tax returns, then strictly, if you know you need to file a tax return, you should register with Hmrc by the 5th of October following the end of the tax year. If, for example, you've missed that for the current filing season, I would urge you to register as soon as possible, because Hmrc are in a little bit of strung out shape due to COVID. Late filing penalties and late payment penalties will apply after 31st of January at various different stages. So the guys at TaxScouts have asked me to speak about this slide. Just to be clear, TaxScouts is a platform that will connect you to a tax advisor or an accountant, and they will collect all of your data, assign you to an accountant, and that accountant will send you your return, and once you've authorized it, they will file it, and there is an all-in cost price for that of £119. So feel free to navigate over to TaxScouts and check out their website.
Awesome. Thanks for helping out there, Stuart. What I'll do is just quickly show a demo of the product. So this is Crypto Tax Calculator. You'll see a page like this, and you can sign up here. Just to point out, we've got almost 500 integrations now. I think we actually ticked over about 50,000 users a couple of weeks ago. What you do once you do sign up to the product, you'll be taken to a screen similar to this, and you could type in something like, say, finance was popular before getting blocked in the UK, and you've got this CSV import here and the API, for example. You could do the same, for example, with Coinbase. Here we've got an Ethereum address already added. So you could enter in, for example, if you've been trading on Solana, you've been doing NFT trades on Solana, you'd enter your wallet address, and then we'd pull that in. That's always good to have that happen on a live demo. I think it just has stale connection there. Once you click on the review transactions page, you can see here you're able to review all your different transactions. Here we have an example of the UK tax rules that are going to show up once it loads. But essentially, that's quite a complex one. But you'd be able to go through and break out each single transaction and see exactly how the results are being calculated. It's just refreshing at this point. And then you can generate different reports. So you've got your different financial years here, and you can download those reports and send them over to TaxScouts. You can download them as PDFs as well as CSVs. So here we've got the capital gains report, for example, and you just click download CSV, or also the PDF, download PDF. And then this is an example of the reports that you're able to send over to your tax advisor. Fairly straightforward system. And then once everything's done, you can also have a look at your dashboard and see exactly how your calculations have added up on your dashboard and what your remaining inventory is as well. So one major benefit of being able to reconcile all your transactions is, at the end of it, you've actually got a portfolio that's actually up to date, and you can see what your net profit is based on your current cost basis, and from there, be able to work out your unrealized gain as well. So I'm conscious of time, so we've just got 10 more minutes left. So maybe I'll stop sharing my screen, and you guys we can have a look at some of these.
The first one that I'd really want to bring up for Stuart, if you don't mind, is that if someone's made, let's say, like £5,000 less than the annual exemption, do they still need to declare their gains, even though they're, of course, less than the 12,300? Oh, Stuart, you're muted.
I'll start again. As I said earlier, it's the two tests. So if the gain is less than 12,300 in sterling for the year, and the proceeds of all asset sales are less than 49,200 sterling, then there's no obligation to report. If you go over one of those limits, then there is an obligation to report.
Fabulous. Thanks for that. Then the next one we've got, a pretty popular one, is how does the HMRC view stolen or lost crypto? Is that a deduction?
I want to say no, but I would need to check. Shane, I don't know if you've come across that.
If it's a disposal, I'd say definitely want to talk to your tax professional to work out under what circumstances. You might even be able to talk directly with the HMRC and try to get a private ruling on that.
Yeah, because it's a tricky one because I don't know how they would view the asset being irrecoverable, right? There are CGT rules around the destruction of assets. There are also CGT rules around an asset becoming of negligible value. But I seem to recall that HMRC's guidance on lost or stolen coins is that would not be allowable. So I would urge you to, if that has happened to you, I would urge you to seek advice.
Awesome. That seems to be a bit of a common theme today, especially with all of these complex ones. And actually, speaking of complex ones, I'm going to mention to Shane, if you don't mind, I know you're not the biggest fan, but what about rebasing tokens like Ohm, like Olympus and Time? How is that in your perspective, like from your thoughts from what you've seen taxed?
Yeah, we don't know of any tax authority yet who's really given a clear view of rebasing tokens and what that might be. There's a fairly strong argument that it might be similar to an airdrop or even like maybe income at the time of each transaction. Personally, I haven't touched rebasing tokens because it sounds like an absolute tax nightmare. So I had talked to some accountants who were saying that they were advising their client to every time they did any transaction to record what the quantities were before and afterwards. So say if you had Moon, every time they open up their MetaMask, they'd have to record that. Still not super clear what that's going to be.
Fair enough. The next one we've got, that's also another very popular one. It's, for example, when you're farming, when you're staking something and you get rewards only when you claim them. So for example, it's the same in Ronin, it's the same with Cardano. You might get the rewards every 6 seconds. Are you taxed when you actually get the rewards, or are you taxed when you claim them? Do you have any thoughts on that one, Shane?
Yeah, so that's a really another gray area. The recent suggestions that we've had might be that they're taxable on beneficial ownership. So what might that be? It could very well be, for example, this case that we were looking at a while ago was like, the ETH and ETH 2.0 and the Ethereum that you send over to ETH 2.0 is kind of locked and you're earning interest, like staking reward interest, and you can't even cash that out yet. Is that taxable or not? Like, is the income still taxable? And kind of indication that we're getting is yes, because you've still got kind of beneficial ownership. So pretty aggressive perspective, I'd say. Definitely talk to your tax professional.
Yeah, it's difficult. It's a difficult question, right? Because you legally own that reward. You just haven't chosen to move it from A to B. If I'm understanding correctly.
Yeah, correct. And it's kind of like, even if you can't move it because it's fixed, it's like a fixed term deposit. The income being earned into it is still there. You've kind of gone into the agreement knowingly. It's there be dragons. You've got to consider this. You've got to consider your tax exposure, particularly if there's going to be large fluctuations in that crypto, and you might not be able to withdraw it to actually turn into fiat anytime soon. It's really, definitely something to consider.
Most definitely. I think one final thing that we wanted to touch on, unless someone has a final question, is about NFTs. If you wouldn't mind covering that, Shane, real quick. I know it's pretty simple, but a lot of people are still confused.
Yeah, so NFTs can be quite complex in itself. For example, minting an NFT is the minting event, like the Ethereum paid to mint the NFT. Is that just an expense, or does that form the cost basis of the asset? Again, the Hmrc, I don't believe, has come out with specific guidance on that, but following some indications that we have globally, and again saying, this isn't tax advice, it does seem like it, from global kind of where it seems to be pointing is that kind of gas fee would form the cost basis. It's not just an outright claimable expense. It's very similar, really, like what's really happening is it's very similar to just paying ETH for an NFT. If you're disposing of ETH to purchase 10 NFTs, like you can group it, well then in our system that actually gets split between all those NFTs, so the ETH gets forms the cost basis for those NFTs. The other one that comes up with NFTs is royalty payments, probably similar to income, I'd say. But I'm still waiting on very clear guidance around this. But
we just got a question from Vinny. So it looks like they have coins to the value of under the capital gains tax limit, so under the 12,300, but they plan on appreciating that the next year. So they just want to know what will happen in that case.
Yeah. So, Vinny, if you're saying that you've purchased assets, they've risen in value, but you still own them, and you haven't gifted them, you haven't swapped them for another asset, you haven't purchased goods and services, then that unrealized gain is not taxable. As we said earlier in the presentation, the tax points are selling or giving the asset away, swapping it for goods and services, or selling it for another cryptocurrency. So I hope that answers your question. I guess that also links back to the earlier comments about the bed and breakfast rules for UK purposes, because obviously a lot of people, what they might do is the annual exempt amount for capital gains tax purposes of £12,000, you either use it or you lose it. And so someone at the end of the UK tax year might think, oh, I'm sitting on an unrealized gain of £12,000. I want to sell some assets and realize that gain. It's tax free, but then I want to buy those assets back because I think they're going to increase further. And obviously, in that point, or in that example, you would need to be out of the market for that specific currency for 30 days. Otherwise, the bed and breakfast rules apply and the transactions never happened.
Fabulous. In that
Sorry,
case,
Paul, there's a question there from Paul. I don't know if I was clear, but swapping a crypto or trading a crypto from Bitcoin to Theta in your example, that would be a taxable event. We're really at the sort of end of tax advice here because you're asking some quite personal questions that I would not like to answer off the cuff. But last one, Dominic, if you gift assets to your wife, those are transferred at no gain, no loss, and she would inherit your base cost.
Too good. Stuart, did you want to answer that final question? Or do you want to leave it there for today?
I mean, I appreciate on both the chat and on the questions tab, there are loads of questions. And as Shane and I have sort of said, this is an emerging environment, and it's very difficult to give tax advice in kind of broad brush strokes, because each individual taxpayer and each individual transaction can be very different. So, I would urge you to reach out and ask those questions, after the event, and consider, taking professional advice from a tax advisor, because, there needs to be know your client checks and, a contract in place. This webinar has just kind of been on a sort of advisory basis. Okay.
Yeah, absolutely. Thanks for your time there, Stuart. Yes, we're doing a lot of work with the HMRC, like starting to try to develop, I guess, a relationship with Hmrc to move some of these conversations from grey to black and white. But in the meantime, they are still grey, and you're definitely worth talking to a tax professional. There's definitely different perspectives on existing tax laws and how they could be perceived, and where the tree is going to fall. But it's certainly, we've just got to work with what we've got at the moment, given the grey areas at hand.
And Shane, sorry, I've just had a message from Patricia at TaxScouts, just talking about the discount that CTC users get from TaxScouts service. So she's asked me to mention that.
Yeah, absolutely. So if you're using TaxScouts, you can get 20% off the product as well. We'll post the link in this where this is recorded afterwards.
Perfect. That note,
Yeah,
I think we'd be happy to wrap
on the chat. I would echo Stuart Roberts' comment, which says, "Thanks for your time, guys. Much appreciated. What a minefield."
Yeah. I'd say one of the biggest ones that come up consistently from a support perspective is the 30-day bed and breakfast rule. That reordering of transactions, it's very unintuitive, and it almost looks like a bug when you first look at it, because it's like, why are you selling something and then buying it again, and the buy is actually reordered to before the sell. It's quite unique, and it's definitely good to keep on top of some of these unique rules that the Hmrc has. So thanks again for joining us, Stuart. Really appreciate your time. I know it's been an incredibly popular chat, so we'll probably try to do something similar like this again in the future.
Perfect. Thank you, everyone. Don't forget the recording will be available. It'll be sent out by email and also be on our potentially on YouTube and Facebook, but everyone will definitely receive a recording of this. And I have put the link that Stuart you mentioned in the chat, so feel free to check that out here. Perfect.
Thanks, everyone.
Thanks everyone for
guys.
your time. Thanks, Shane.
Bye.
Thanks, Stuart. Thank you, Max, for joining.
Bye-bye.